Good morning, everybody. It is Wednesday, June the 10th, and here's what is on our agenda. US strikes on Iran, testing overnight the ceasefire. US inflation set to jump after that hot jobs report. We watch Fed expectations. And Chinese factory gate inflation tells the AI and war effect story on prices.
So European futures today pointing to gains of 0.2% after the losses of about 0.5% yesterday. To Anna's point, the central focus for the markets today, beyond the geopolitics, will be that inflation print out of the US, and after the hot jobs report that we got on Friday, US futures pointing lower by 0.3%. For this month at least, European stocks have outperformed their US counterparts. We'll see if that continues. On the oil story then, Brent at $91 a barrel, down 0.1%. The continued volatility out of the region and the focus, of course, on the conversation between the US and Iran. But right now, Brent is at $91 a barrel. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. It's just gone 7 o'clock then here in London. Let's get straight to today's Wednesday agenda. And we start then, Tom, with the oil price and its response to what's been going on in the Middle East. So we're pretty flat, as you've been saying, on the Brent price this morning at 91.32. But that doesn't really tell the story of the last 24 hours. We got down to the high 80s on the oil price, on the Brent price during yesterday's session, but back up overnight above 90. This as the US takes what it says is retaliatory action for the downing of that helicopter that we talked about yesterday. So the US attacking Iranian military targets. Iran says that the attacks went wider than that. The US, though, then signalling that they have finished their activity with this particular purpose in mind. And so oil did rise, but then it pared those gains a little bit. The Iranians, though, this might not be a done deal for them. The Iranians saying they will leave no attack unanswered. And they tell Gulf countries not to allow US troops on their territory. So all of this raises questions about the fragile nature of the ceasefire, the extent to which it still holds, and where is this peace deal? Where is this extension of the ceasefire, if that is all we are realistically to expect?
And if we step back and look at the oil price action, and currently Brent at $91 a barrel, as the US and Iran trade military blows, in some respects, it's pretty remarkable that we're not seeing a much higher print on oil prices. Maybe part of this is down to the demand destruction that the US government is pointing to, about 1 million barrels per day. We know, of course, China's been cutting back on its imports. We know that Asian governments have been putting in place measures to restrict the purchases and the demand around oil. That has been a factor. But also the news today from our team covering this, that Kuwait has actually successfully, or at least is putting on the market now for sale to its Asian buyers for the first time since the conflict, its own crude, potentially around 4 million barrels per day on ships that have crossed through the Strait of Hormuz and now apparently on the way to those Asian buyers. So it's a reminder that there is a trickle, at least, going through the Strait of Hormuz. All of those factors seemingly playing that role in capping oil prices, at least for now, but we know inventories are drawing down.
Yeah, it is a trickle, isn't it? But it is something. It is something that seems to be getting through the Strait of Hormuz. Nothing seems to be going back in, but and much that is coming out is turning off its transponders, so it's very difficult to get a sense of how much is coming out. But it is notable, as you say, that Kuwait is offering this crude to Asian buyers for the first time since the war began. So that's the oil price. It is perhaps surprising, as you say, that it is not higher. But that takes us to a lot of inflation data and the broader risk conversation and the big risk event, I suppose, of the week.
Well, if there isn't volatility in the oil markets, at least in terms of the context that we're seeing, in terms of volatility on geopolitics, then certainly it is there in the equity markets. And we're seeing that again, very pronounced in Asia, with the Kospi right now over in Korea down close to 6%. So Asian markets across the benchmark set for the fourth straight day of declines, or fourth day of declines out of 5. It's been very volatile. The VIX is up. It's at 19, so it's not at the most extreme levels, but the VIX is up since the start of this month by about 30%. So volatility has ticked up. You're seeing today a little bit of pressure on treasuries. Yields are up. You're seeing significant pressure actually on gold and Bitcoin. Bitcoin having one of its worst weeks in the context since about 2022, and gold back below $4,200. And that does tie in not just to geopolitics and concerns in the equity markets about valuations, but the question about inflation and what the print is going to look like today. 3.8% on the headline level is the forecast.
Right, yes, I think expected to go from that 3.8% up to above 4%. So that is certainly going to be the area of focus this morning, or going into the afternoon European time. And of course, Tom, this comes on the hot on the heels of the December print for jobs, which was, for the print, the jobs print just at the end of last week, which meant that we increasingly were pricing in a December hike from the Fed. And so where does that leave us and leave our thinking, and where does that leave vulnerabilities in the markets? You mentioned the gold price. The gold price has been dropping, and some people pointing to that as an area of concern that we are getting closer to interest rate hikes coming through from the Fed. So a lot of focus on the fact that historically the headline number for inflation, as Lizzie was pointing out to us, does have a history of coming in hot, of outperforming, of coming in with upside surprises. So we'll watch for airfares, appliances, electronics, all of these things set, according to Bloomberg Economics, to push inflation higher, above that 4% this time, compared to the prior number of 3.8%.
Yes, 4.2% being the May forecast versus 3.8%. Talking of inflation, that is upcoming. We have had already the inflation data out of China, and that is fascinating in terms of the split, the divergence you're seeing now between consumer prices that essentially remained unchanged in the most recent month versus the producer prices, which ticked up pretty significantly. Part of that is energy, but interestingly, part of that is the AI demand as well. But that divergence not necessarily telling a positive story for the domestic Chinese economy.
Absolutely. So these businesses, these consumer-facing businesses, perhaps then having to take this on their margin, because, yes, you see PPI really responding to the dual challenges of higher AI, electronics prices and higher energy prices. That's the PPI story, but you don't see it in CPI. They can't pass it on to consumers. And as a result, this is bad for the margins of those businesses, and raises questions about whether the Chinese consumer is going to be able to step up. So we do expect this is a country to exit deflation this quarter, but it's not smooth sailing in terms of a more solid footing for the consumer price story.
Yeah, so 3.9% on producer prices versus 1.2% on consumer prices. Producer prices 3.9, consumer at 1.2 out of China. And there's another question as well as to whether or not China starts to become reflationary in terms of its exports, given producer prices are close to 4%. What does that mean in terms of higher prices as they export maybe some of that inflation to their global customers?
Let's talk about some of the things that are coming up today then. We've already talked about US CPI. That's going to be a highlight from a data perspective. But we have one big event taking place here in Europe from a markets perspective, and that's Super Return in Berlin. Scott Kleinman, the Apollo co-president, will be with us really shortly on this programme. Danny Berger on location for us to tell us all of those private market stories. James Reynolds, Goldman Sachs Private Credit Global Head, will also be joining Danny. Plus, we'll be joined by Emma Moriarty, CG Asset Management Fixed Income Portfolio Manager. What is at stake now with this CPI print following on the heels of that jobs report? What is at stake for Fed expectations? And Marina Zavalot will be with us, Morgan Stanley Chief European Equity Strategist. Interesting that we saw headline the indexes drop in the States yesterday, but so many component parts of those US markets actually moving higher.
Let's look at what else we are monitoring throughout this Wednesday then. The Bloomberg Invest event begins in Hong Kong. Some great names there that we're speaking to. Of course, the annual Super Return gathering gets underway in Berlin. Danny Berger is on the ground for us. We're going to hear from some of the guests attending throughout the day and in this show. And at 9 a.m. UK time, we're going to get Italy's industrial production data. 1:30 p.m. UK time. It is that key data, of course, out of the US with May CPI, Consumer Price Index data, coming out later. That is a big one for us. We'll be across that for you, of course. And after the market stateside, we'll also get on the earnings front Oracle's fourth quarter results.
Yeah, just how quickly can they build those data centres? Now, much of the private capital industry's top brass, they're convening in Berlin this week at the annual Super Return conference, just as the boom shows signs of faltering amid unprecedented withdrawals from retail-focused funds. For more, let's get to Bloomberg's Danny Berger, who is at the gathering in the German capital. Danny, great to have you on the programme. And set the stage for us around private markets right now. Such a boom area a couple of years ago. Such a focus on their exposure to software over recent months, and then are retail investors therefore just as excited as they used to be? What's the mood there?
And I mean, this conference is just kicking off, and I have to say, about a year ago at this conference, Robert Smith from Vista basically made this declaration: 60% of people in this audience aren't going to be here because AI will have replaced their job. I say it's early here and it's already busy. So yes, there are the headlines, there are concerns about private credit and redemptions, but the mood here is still one of strength. But around private equity, there's this real question. M&A volumes have been really robust to start the year, but a lot of that sponsor-backed M&A has been somewhat absent. In fact, volumes are down about a fifth so far this year. And I have the perfect person with me to discuss that. It is Scott Kleiman, the co-president of Apollo. Scott, thank you so much for joining.
Great to be here.
And look, this is a topic that you have been a leader on talking about. I think it was, 2 years ago? It wasn't 2 years, right? Or was it last? Yeah, 2 years where you talked about this idea. It's a pig making its way through the python, and we're not there yet. Still, it's been 2 years of LPs asking for their money back. Volumes are still down. The SaaS apocalypse certainly didn't help. I mean, has this whole thing just been set back? Are we going to just be kept waiting for this digestion period to finally finish?
Yeah, I think that's the right way to think about it. The pig is literally moving through the python. Maybe it's 2 years ago it was in the abdomen. Now it's sort of moving a little bit further down. But yeah, there was 10 plus years of 0% interest rates where sponsors went on a buying spree, paid ever increasing prices for assets, generally good assets, but now they're stuck holding these things. The inventory, as you alluded to, of private equity owned companies is really, really high. And it's tough to exit those companies at valuations that sponsors in general want to sell at. And so, yeah, I think we are somewhere still mid-river, waiting to get to the other side.
I had a banker make the comment to me the other week that it just shows that something about private equity is broken because it's a promise. You give me money, I buy an asset, I sell it, I return. And public markets have been really robust. They're at all-time highs. As I mentioned, strategic M&A has been really high, too. So what has gone wrong? I mean, is this a promise broken for this industry?
I would say I think the industry lost its way a little bit. I've been pretty vocal on that. The industry was founded on finding good assets, pay a reasonable price for it, operate it better. When interest rates went to zero and stayed there for a decade, the equation changed to find a good asset, don't screw it up. What you paid for it didn't really matter because at 0% rates, valuations always went up. When all of a sudden, in 2022, 2023, we saw rates move 500 basis points, that changed everything. I'll make a shameless plug for Apollo here, but this is where, fortunately, we didn't get the memo that the cycle was going to last a decade and stayed very disciplined on valuation. And as a result, we've been actually pretty active selling and exiting companies.
And did things like avoiding software. I mean, you mentioned higher rates. We're going to get CPI today. The odds have now shifted to a rate hike in the United States, certainly here in Europe, too. Does this just exacerbate the problem even further?
Well, exacerbated if you thought rates were coming back down. I think we've been pretty vocal that rates were going to stay at these levels for a while because we didn't see the economy slowing down. We didn't see a need for rate cuts, and I think that's probably where things are headed.
So we're going to get some mega IPOs. SpaceX this week. We learned that OpenAI is filed for an IPO. We don't know when we'll get that. Anthropic's going to be coming soon. Do these big IPOs, is it helpful for this industry? Does it open up the gates to allow people to exit? Or is it we're all competing for the same institutional capital, and unless you're SpaceX, it's a bad environment to go public?
No, it's a little bit different. Again, this is not about the ability to exit. We've done 4 IPOs in the last year, several sales. There's capital available. It's just you may not like the valuation that's being offered. So if you've paid a reasonable price going in, you can get out in this environment. If you've paid a high price going in, well, you're kind of stuck. Most of the assets that private equity owns are not SpaceX or Anthropic. And so when you look at, the S&P setting new records, every other week, it's a dozen companies, right? It's not, the 490. And it's certainly not the next 2,000 companies. Most of those companies are trading at pretty, reasonable or modest valuations, which is why the new money environment for making private equity investments is pretty attractive right now. We've certainly been active. Others have as well. You mentioned volumes are down slightly for new M&A, but it's still a pretty robust environment for making new investments.
Again, it's just the exit picture that we're stuck on. So what eventually happens? Is there something that happens to this industry that we say, okay, we need to come to terms with this, we need to take a valuation hit and just sell that stuff? And what prompts that if that does happen?
Yeah, the passage of time, right? So as long as there's not an intervening recession, these companies are accreting in value, and you get closer and closer to your target valuations, even if multiples have come in. And so each year that passes, you will see.
Does that make it harder to exit, though? Because they get bigger. So your options of where you sell this company are more limited.
No, in the grand scheme of things, what it means is you're generating cash flow, you're paying down debt, you're creating more equity value, and you're approaching that target MOIC. Now, your hold period is extended, and so that's impacting IRRs, and so you are seeing IRRs come down in the industry for that 17 to 22 vintage. But no, with the passage of time, you'll see it. But yeah, folks are going to have to start capitulating, for sure.
What does capitulation look like? Is it painful? Is it a reckoning?
Well, I think you will see a shrinking of just the expansion of private equity firms that you saw over the last 10, 15 years. You'll see firms raise smaller funds. You'll see some firms go away. That's just the nature of the cycle. Yeah, for sure.
A lot of this current private capital cycle, too, a lot was pinned on the hopes of democratization, of more retail funds. Very much so private credit story. It kind of leaked into private equity with the latest on Partners Group and their Evergreen Fund. I just wonder if that's part of the conversation here, too, that we've rethought that as the next pillar of growth for the industry.
Yeah, look, Apollo's been very vocal. We have not brought a retail private equity fund because we just haven't thought that's sort of the best asset for that asset class. And so for the very reasons that we're seeing in private credit, at least in private credit funds have maturities, debt have maturities, so you get your money back eventually if you move into a withdrawal cycle. In private equity, as we've seen, it's been 3 or 4 years with depressed monetizations. That could be pretty painful in a retail type product. And so we've been cautious on that. We know others have pushed into that. We've tended to stay away in a wealth or semi-liquid private equity product.
Do you think that's kind of the next evolution of this? Again, we kind of saw echoes of that, but it starts with private credit, but now you have retail rethinking exactly for the reasons you're saying about their holdings in private equity.
Look, remember, limitations on the semi-liquid funds withdrawals is a feature, not a bug, right? It's meant to protect the rights of redeeming investors and remaining investors. And so you will always see the ebbs and flows of that in a product like that. It's not a bad thing or a good thing. It just is. It's just the media makes a lot of hay out of that when you hit those points.
So it's our fault, Scott. I see where this is going.
No, but the point is it's a different type of product.
Right.
But yeah, you will absolutely see those points in the cycle for wealth private equity products, just like you do in wealth credit products.
Yeah, and again, I know a tiny sliver of Apollo as a whole is the retail products for credit, right. And again, not really existent for equity. Scott, thank you so much for joining. Always a pleasure to start the mornings with you.
Yeah, great to be here.
London, I'll send it back to you. Anna, Tom, that's of course Scott Kleiman of Apollo.
Okay, Danny, fantastic conversation. Thank you, Danny Berger, at the annual Super Return gathering in Berlin. And our coverage, of course, from Super Return continues throughout the day. We're going to be speaking to guests, including Victor Cosa from Strategic Value Partners and the Thoma Bravo co-founder, Orlando Bravo.
Coming up on the programme, we'll go live to the Middle East as fresh US strikes overnight on Iran risk prolonging the near-total closure of the Strait of Hormuz. Plus, the global energy crisis and AI boom drive inflationary pressures in China. We will unpack what is happening there. Up next, though, we'll talk about AI. Anthropic releases a new version of its Mythos-AI model without its much talked about cybersecurity capabilities. We'll have the details next. If you want to get involved in any of these conversations, please use the function IB plus BBTV Go. That's on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade, Wednesday the 10th of June, and the European futures picture looks broadly positive. Perhaps the FTSE 100 underperforms just a little bit. We've seen quite a lot of volatility in the oil price since the closure of these European equity markets, but we're now back to $91 a barrel on Brent. US markets closed down yesterday, as we were pointing out earlier, but quite a lot of the components, Tom, actually managed to head higher.
Here's what else you need to know this morning then. Australian firm Cigna Healthcare has confirmed it has engaged in preliminary discussions in relation to the sale process of UK retailer Boots. The FT earlier reporting that private equity firm Sycamore Partners, which took control of Boots through the acquisition of its parent company in 2025, had started talks with potential buyers over a $10 billion sale. If a deal takes place, it would mean Sycamore could abandon plans for an IPO of Boots in London. Supermicro shares fell in extended trading after it announced plans to raise $7 billion through a package of equity offerings. The proceeds will be used to purchase components needed to fulfill customer orders for its AI servers. Supermicro says it currently has around $39 billion in outstanding orders. Anthropic has released its latest Mythos-AI model, Fable 5. Though with one major caveat, the company says it will be blocked from responding to queries related to cybersecurity and biology. The rollout will also be joined by Mythos 5, a version of the same model without such guardrails, to be used as part of its Project Glasswing initiative. Meanwhile, Anthropic's CEO has told Bloomberg he thinks AI will make the software industry larger, not smaller, although firms that don't adapt will disappear. Dario Amodei spoke exclusively to Bloomberg Originals.
If you pick a business model that fundamentally conflicts with your values, you're going to have a hard time, right? Either you betray your own values or you become irrelevant. And so when we thought about it, we said, look, we've seen the world of social media, the consumer world, it really seems to, encourage engagement, even addiction, the slop we've seen with AI video models. It's like, what's going on is it want to maximize the number of minutes that you're paying attention to, because that's the advertising revenue driven incentive. Whereas if we look at enterprise, look, we want to make these models useful to people. We want to use AI to cure diseases that we couldn't cure before, right? Well, that's working with biotech, it's working with pharma, it's working with academic research groups. All of those are enterprises, right? We want to use AI to to make energy cheaper and more efficient. That's all enterprise. And so I think it served us well to have this business model that largely aligns with our values.
Soon after Claude Cowork was released, $285 billion in market value vanished overnight. Traders called it the SaaSpocalypse.
This kind of white-collar wipeout story in the software sector, terrifying.
Some of those are down for 9 days in a row, so clearly the tension is building.
If AI continues improving at this pace, how much of traditional software gets replaced and how fast?
I think with AI, the pie is getting bigger, right? So the existing incumbents may be smaller in relative terms. Some of them may go down in value. Some of them may even go out of business if they don't adapt in the right way. But I would guess that the software industry gets larger, not smaller, although there will be some big losers. Those who don't kind of see what's coming, who don't identify the moats they have, they're going to have a really hard time.
So it's all about the moats. You can see the full conversation and that latest episode then of The Circuit with Emily Chang. That's from Bloomberg Originals, of course. So go seek that out. It is all about the moats then. Not all software will disappear, so says Dario. So that is interesting. I was also drawn to the reporting around the circular nature of some of the deals that support the build-out of data centres right now. And some of that involves Anthropic and Google. I'm losing track. They compete, but they also are in business with each other. It's kind of incredible frenemies relationship.
It really is. So Gemini competing with Anthropic's products, but we have that reporting that Alphabet, the Google, is backstopping, essentially, Anthropic's leasing of 5 data centres around the US, which accounts, or at least amounts to, essentially a $35 billion loan from Google and its balance sheet to Anthropic. They are underpinning those leaseholds for those data centres that, of course, are so important to Anthropic, a company into which Google and Alphabet have invested as well.
More on the AI story as we continue. Coming up on the programme, though, bond traders raise bets that the Fed will hike rates. That's been the story since Friday, of course, and that incredible jobs report and the market reaction was been much discussed on this programme. We'll get back to that. We will speak to Emma Moriarty from CG Asset Management ahead of today's US inflation print. Will that have the markets double down on expectations for a Fed hike in December or pull back from those expectations? That is next. This is Bloomberg. Welcome back. The opening trade is 30 minutes away, and the European futures picture, well, it looks broadly positive, not expected to go higher by much. And I should point out that US futures are pointing lower. So clearly some nervousness, in particular around the tech story, continues because Nasdaq futures are down by around 0.4%. And yesterday it was in particular volatility around the tech story that led to the weakness that we saw in markets where we saw weakness. And that continues to be an area of concern, doesn't it? The AI story as we approach some giant listings just this week.
And this month, European markets, European equities have outperformed their US counterparts, at least so far this month. Let's check in on the bond market moves then. We are building up, of course, to CPI out of the US around 1:30 p.m. UK time. So that macro event is front and centre. Right now, you're seeing a very modest amount of selling coming through across sovereign debt of Europe. French OAT, 382 right now, yields up 1 basis point. You're seeing a similar picture for BTPs over in Italy, 381 yields up, just 1 basis point, largely unchanged on the German benchmark, which is yielding just over 3%. So bond traders, of course, increasing their bets on Fed rate hikes ever since Friday's surprisingly strong US jobs report. Today's US CPI then print expected to show continued price pressures. Let's bring in Emma Moriarty, portfolio manager at CG Asset Management. Emma, how crucial is this inflation story that we're getting today to confirm and lock in expectations of a hike? Do you think that's what we get to at the end of today, locked in and ready to go with a Fed hike this year?
Yeah, I think it's really difficult because on one hand, this upcoming Fed meeting is going to be Kevin Warsh's first chaired meeting. And of course, he was sort of understood to be a candidate who really wanted to cut interest rates. And that's just not the situation that the US economy is in at the moment. We've had very robust growth for some time. We've had strong jobs prints for a while, and we've got US CPI this afternoon expected to come in above 4%. So it's all looking quite difficult. I think probably the situation is, as expected by markets, for a hold to rates this time. But if this is something which is set to continue for the rest of the year, then it will be looking quite difficult not to hike.
OK, so a hike if the inflation data comes in as expected, 4.2% is the expectation from 3.8%, and then a hike becomes more likely. Where does that leave the trajectory then on the data that we currently see today as we look through the end of this year and into 2027? If they end up hiking this year, do cuts come through in 2027 for the Fed, or is the structural and the foundation supporting this US economy enough to propel further upside potentially?
Yeah. So I think it's difficult. If you look at the economy as it is at the moment, inflation's now looking quite strong. Growth is looking very robust, kind of at or potentially above trend growth rate. So you'd have to look at the interest rate setting and say, well, versus neutral, it's possibly looking a little too low. Of course, there's a separate question about what goes on in, say, US equity markets, and whether if we see any weakness down the line there, that's something that then begins to undermine the AI capex going on in the economy, which has held up so much of US growth for a while.
Emma, good morning. Just by way of a thought experiment, if we could go to a world where Kevin Warsh is not coming in as the new Fed chair, how many hikes do you think the market would be pricing in if we sort of remove that as an unknown quantity?
I think potentially a couple more. I think one of the things that's notable about the OIS curve for US rates was, despite the fact that inflation had been rising because of AI spending and then there was the additional shock of the war in Iran, OIS markets were really slow to price in rate rises for the US. And it was really, after sort of sustained strength and then sustained job market strength, particularly, that things started to turn. So it might have been looking something more like what's being priced in for the US or the UK, where there's a few additional rate rises.
OK, so yes, they're in quite different camps now, aren't they, Europe and the United States? We talked to a guest yesterday from BNP who was saying the US is looking as if it might hike because of real strength in the economy, whereas Europe is going to hike because of inflation concerns. Sticking with the US for a moment, I know that you think we're going to see a steepening of the curve. So do you think then that the Fed will not be able to tackle inflation in a timely manner and we get more term premium at the end of the curve, there's more expectation of more supply coming in, and that we get a steepening effect on the yield curve. What are you looking for?
I think that's right. And it has been the case that, even if we take Kevin Warsh out of the equation, the revealed preference of the FOMC so far in this cutting cycle seems to have been for a slightly looser policy setting than might have been justified by the data. And now that we have someone who's coming in and has specifically said that they think the interest rate setting for the US should be lower, the expectation, I think, has to be that we probably won't see the number of rate rises needed or as quickly enough as we can to bring inflation under control. And then you get into questions of, OK, well, how big does term premium have to be to compensate for those expectations?
And the risk of second-order effects and wage increases and shifting expectations around inflation. I mean, that is potentially the risk if things play out as you expect from the Fed.
Exactly, and I think whereas the debate in, say, Europe or in the UK has been about, well, we've had this inflation shock, but actually the rest of the economy is not so strong, the labour market's not so strong, and therefore the likelihood of second-order effects is much lower. That's not the situation in the US, and the US is coming in with a strong jobs market at a moment when actually immigration's been cut quite materially, so things could be looking really tight in the US job market if all of this is to continue.
The markets are pricing in for the ECB potentially 3 hikes by the end of this year. Is that what happens to the Eurozone economy if we get 3 hikes from the ECB?
Yeah, I think that's going to be fairly challenging for the Eurozone economy. On one hand, you can look at it and say, well, the ECB has a single mandate around price stability, and that naturally will make it more hawkish about what it signals around inflation. On the other hand, the business of central banking is all about aggregate demand management, and if actually what's going on is there's weak demand, budget deficit constraints in the UK and sort of just structurally weak growth, then increasing policy rates 3 times over the next 12 months could be quite self-defeating.
What about increasing the policy rate once, Emma? If we get a hike this week, will that be a mistake?
I think it's complicated. I mean, if you look at euro area growth at the moment, it effectively rounds to 0. So you can look at it and say, well, we've got a weak demand problem, which might be getting made even worse. But the ECB is quite clearly tossing up between that and the reality that inflation's on the rise, and the crisis that's been going on in the Middle East and the impacts on energy markets are now something that looks much longer than something they can look through.
And finally, on the UK, Emma, we spoke to another guest yesterday who flagged the elevated household saving rates in the UK as a sign of consumer caution, I think. And I note that you mentioned the same thing in your notes. What do we take away from that? What's the message, and what does that mean for policy?
I think it's sort of similar to the euro area. It's this idea that actually, interest rates may not have to rise by as much as OIS markets currently predict. And the reason is there's less likelihood of these second-order effects in the labour market and kind of, through sort of general economic activity when actually, the prevailing demand conditions are not particularly strong.
Yeah, so the market kind of did the central bank's job for it a little bit.
Yeah.
Emma, thank you so much. Thanks for joining us. Good to see you on set this morning. Emma Moriarty, Portfolio Manager at CG Asset Management. Coming up on the programme, China in focus. Chinese consumer inflation unexpectedly stalls in May. Producer prices really rising, though. Details next. This is Bloomberg. Welcome back to the opening trade, Wednesday the 10th of June. European equity market futures point a little bit higher this morning. A bit of catch-up to be done in the US perhaps, but we have US futures actually pointing lower. In particular, NASDAQ futures seem to be losing their footing once again, Tom. We're down by 0.4%, and E-minis down by 0.3%. So we see the green on the screen, but we're cautious perhaps about the trading day ahead.
Yes, and some caution as a result, maybe, as a result of the inflation data out of the US, CPI data, of course, which is going to be front and centre for many investors in terms of the inflation dynamics of the US. Meanwhile, China's inflation and the split there has widened. Consumer price rises unexpectedly stalling in May, while factory prices gained at their fastest pace in almost 4 years. Let's bring in Bloomberg's China economy and government editor Alan Wong for the details on this. Alan, what exactly then kept consumer inflation so weak in May, despite what we saw in terms of factory prices up and up pretty sharply?
Yeah, Tom, it's the old story. In China, the weak consumption sentiment is effectively to seal consumers off of the global commodities rally. If you look at something like pork prices, they fell 16% compared to the same period last year, which basically shaved off 30 basis points off of the headline CPI number. And overall, obviously, there's the same old story of China's home prices falling, and that also contributed to a really modest rise in the CPI.
So that's the CPI picture. Global factors like AI, the boom in AI that we've seen doing incredible things to memory prices then, Alan, and the war in Iran pushing up energy prices. I imagine that both of those things show up very clearly in the producer price side of the Chinese economy.
Absolutely. So the closure of the Strait of Hormuz and the global energy shock really increased fuel prices for China and as with the other economies. Fuel prices for vehicles in particular rose 21% in China for the month of May. That obviously put a lot of upward pressure on prices for producers. And at the same time, we've heard this very familiar story of the global AI build-out, which really put a lot of upward pressure on prices for things like aluminum, copper, and also chips and other electronic equipment. In fact, the prices in the electronic sector rose at the fastest pace in more than 20 years. So that is something that the AI boom is doing to the Chinese economy.
Wow, so electronic prices up the most in 20 years. That is significant, isn't it? The AI impact is there then in terms of the inflation readings of China. And yet, as you said, Chinese manufacturers are really struggling to pass that cost on in terms of the material costs on, at least in the domestic market. What is behind that? And should we expect maybe China to be reflationary for its export partners? Should we assume that there's going to be high inflation coming from China as it exports those costs to its trading partners?
Yes, that reflation is so far very contained in those sectors where prices are surging. For example, producers that rely on a lot of the higher oil inputs in their production process, and also obviously the AI-related sectors. But then overall, in the other parts of the Chinese economy, we're seeing a lot of still very intense domestic competition that really limits how much companies can pass on the cost to consumers or the buyers. One example is in the traditional manufacturing sector, where lots of companies are still churning out a lot of products and being unable to raise prices just to hold on to their market share. This is made worse by still very weak domestic consumption. When people aren't buying enough goods, they have to export it. So those export prices will also stay quite low. But obviously the exception being that things that like AI or AI-associated sectors, then in those areas, China will have more bargaining power. The companies in those sectors will have more ability to raise their prices.
Yes, we'll see where prices rise and where margins are hit. Alan, thank you very much. Bloomberg's Alan Wong in Hong Kong with the latest on the Chinese economy. Let's turn, with inflation in mind, to the markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore. Mark, good morning to you. I see that the Asian stocks are negative, US futures are negative, and in particular US tech looks a little weaker this morning. NASDAQ futures on the back foot. Is this just precautionary as we head into a big data point? What's new when it comes to the tech sell-off?
Yeah, it is very much tech-focused. It is I guess, a little bit kind of technical in terms of that this has been the boom era of the stock market, or the boom sector. So therefore, people just taking a little bit of money off as they're getting a little bit more nervous. What's interesting is that some of the physical names have really suffered over the last couple of days, which was kind of the latest sector of AI was to really kind of take off in recent weeks. I do think, and we've talked about this a lot in the last week or two, that I think that we're now in the kind of the more problematic end game phase of the AI bubble more generally. Now, how long does that end game last? That's the multi-trillion-dollar question that I can't pinpoint. I think, in prior bubble cycles, we saw that increase in volatility as markets reach fresh all-time highs, whether in the dot-com bubble or in 2008, it wasn't the stock market that made fresh all-time highs, but we saw commodity markets and emerging markets outperform as we were in that kind of end phase when markets were trading broken. I feel we're in that phase now. Does it last months? Does it last, 9 months? I don't know. I think it's probably only a couple of months phase. So in the very short term, yes, this is just technical ahead of CPI. People are worried about a headline print expected at 4.2%, probably has upside risk if anything. And you're certainly seeing that in yields. You're seeing that in other assets in the reaction. We're expecting there's nervousness that yields might be going higher again, and we're going to have to really shift the narrative around what the Fed is going to do this year. So it is technical in the short term, but I think overall the increased volatility suggests that we're in the end game phase of the AI bubble. But I emphasize that's an end game that in prior bubble phases lasted for 6 months, subjectively saying.
So, Mark, there is more. Are you seeing more market sensitivity around this inflation print from the US than maybe typically we would see, given the backdrop that you've just outlined for us?
Completely in context that, up until last Friday's jobs data, we've been kind of ignoring macro data recently. Really, we've just been trading the AI tech bubble versus the idea of what's happening in the latest US and Iran headlines. And in many ways, we've kind of been quick to move beyond US Iran headlines and really focused on the AI tech bubble. Friday's jobs print changed the game. I mean, that was a very, very strong print. And it really, jobs is the one bit that people are nervous about that will kind of prevent the Fed from being backed into hiking rates. So now with that CPI print coming on the back of that jobs print, if we do get an upside surprise today, which is very likely, there's real kind of sensitivity in this market. Now, what's interesting is we've priced in such nervousness since Friday. I actually think there's probably two-way surprise risk now. I'm not sure it's quite as asymmetric as I would have said maybe a few days ago. And I reiterate, my narrative for the Fed is either they're probably on hold or they hike multiple times. Because I think by the time they get forced into doing a hike, that means they are acknowledging they're behind the curve and they'll have to go multiple steps. So it's a little bit binary on the rates path as well.
Mark, thanks so much. Bloomberg Markets Live Executive Editor Mark Cudmore joining us with thoughts ahead of that US CPI print. And there'll be plenty more of that on the Markets Live blog. You can get up-to-date analysis and insight from Mark and all of the Markets Live team. MLIV Go is the function on your Bloomberg terminal that will take you to their latest thoughts. Let's get stocks that we're watching this morning. Alex Morgan has a briefing. Good morning, Alex.
Good morning, Anna. Yeah, let's kick off with WH Smiths, which have got a couple of headwinds this morning. They've just cut their profit forecast year-to-date down about 23%. Now, they obviously last year offloaded their high street stores to focus on travel. Well, they're saying that the headwinds from the Iran conflict, from the conflict in the Middle East, is hitting their travel stores. Also, yesterday, it was announced that there was going to be an accounting audit by the UK into a PwC valuation for the financial year ending August 2024. So that as well could potentially weigh down on WH Smiths this morning. So a couple of headwinds there. We'll be keeping an eye on them. Let's turn it over to Leonardo. That's the Italian aerospace firm. And they're talking up enthusiasm and optimism around a potential deal for European powers to come together and work on a future space defence programme. You can see up around 6%. We'll keep an eye on them this morning. Their new CEO talking up the need for European cooperation. Lorenzo Mariani saying that Europe has to work together intelligently. Now, this is interesting because, of course, yesterday we were talking about that Franco-German next-generation fighter project that was basically shelved. This focus here on space and defence and the need for Europe to come together. We'll keep an eye on Leonardo this morning. And just finally, turning to ASML, we've been talking about that this morning. We've had 30% increase in sales from TSMC. ASML, one of the suppliers of TSMC, so TSMC does well. ASML potentially doing well as well. We'll keep an eye on them when trading opens shortly.
Alex Morgan, thank you very much indeed on some of the stocks that could be on the move this Wednesday. ASML, really fascinating reporting from our team as well in terms of the run-up that the stock has seen, but the fact that in terms of the valuation and the gains, it has missed out versus some of its peers. And there's details in the reporting that's worth checking out on that. Also in tech as well, and ST Micro getting an upgrade over in France. So we could be watching that stock as well. ST Micro set for strong earnings inflection. Bank of America then, that's their view, raising to buy on that stock.
Yes, and the TSMC story getting quite a lot of attention overnight as well in linked developments. TSMC reporting a 30% rise in its monthly sales. That reflects ongoing strength, it would seem, in demand spurred by that global rush into AI infrastructure, a story we know very well. Let me just mention Sanofi on the drugs front, because Sanofi has halted an autoimmune disorder drug trial. And this is the latest setback perhaps for the relatively new CEO, somebody we've spoken to on this programme in her previous guise, but Dario, who is the CEO of Sanofi now, used to speak to us when she was with a German business. The French drug maker said on Wednesday it's going to stop the study of this particular chronic inflammatory drug that was to treat this autoimmune condition, so raising more questions for that particular drug maker.
We can also watch the miners as well, because gold and silver are down again in the session today. 4,200 right now on gold per troy ounce. It crossed below 4,200 at one point. This is on those concerns about inflation, higher interest rates. So we'll see what the impact is on some of the miners. Silver is also down around 0.8% so far in the session.
Yeah, absolutely. Keeping an eye on gold as we head into that inflation report out of the United States. The opportunity cost of holding something that doesn't pay a yield, of course, increasingly in focus then, as we have already started to price in that December rate hike then from the Federal Reserve. That is it for the first hour of the programme. Coming up on the opening trade, we'll bring you the market open. European futures are pointing slightly higher this morning, but US futures still in the red. We'll be back with the market open next. This is Bloomberg. Good morning, everybody. A few minutes then until the start of the equity trading session for this Wednesday morning. And this chart tells the reason as to why perhaps we don't get overly excited about the fact that futures in Europe are pointing a little bit higher, because this tells you the session after we closed here in Europe yesterday over in the United States. So the line, of course, is the closure of European markets. And after that, we saw US equity markets recover a little bit of strength. So we do have European futures pointing a little bit higher, but I would flag that US futures are once again pointing to the downside. So NASDAQ futures are down by around 0.5%. And so ongoing focus perhaps in taking some profits on those AI-related trades. Maybe that is where the market is putting its focus as we approach that CPI data. The CPI print is going to be the big set-piece event of the day, the big data point to watch. And as we were hearing Tom from Mark a little bit earlier on, perhaps there's some two-way risk increasingly around this print, even though the headline number does have a history of surprising to the upside.
So that's the macro. On the micro, some of the individual names we're going to be watching in the tech space here in Europe. ASML in focus. TSMC coming through with some strong sales numbers, an increase of 30%. Sales rising 30% on strong and sustained demand for AI chips. We'll see if there is a positive read-through for ASML. We're watching Sanofi as well. That is potentially a stock that will face some pressure. It's halting an autoimmune disorder drug trial. Latest setback for the company after finding that evidence that is not working, so that is a potential drag on Sanofi. Watch that stock. Also watching WH Smith coming through with a potential impairment charge, and may also be raising additional capital. The impact in the Middle East weighing potentially on that company's numbers, so we watch that stock as well, Hannah.
Okay, so tech in Europe in focus, drug makers in focus. They were yesterday, again in focus on the back of that Sanofi story, and a bit of focus on UK retail as well, perhaps, or global retail, in fact. Let's have a look at the start of the European trading day. We are out of the gate, and the FTSE 100 first to move, pretty flat actually this stage of the trading day, perhaps reflecting the fact that we've got some mixed inputs, if you like, to the FTSE calculation this morning. On the one hand, US markets went higher after the European close yesterday. On the other hand, the FTSE set to underperform, perhaps on the back of some of the mining moves, the oil price moves. Perhaps that's all part of the conversation as well. So the FTSE 100 up, though, by 0.2%, and in fact not underperforming the rest of the market. So the futures had suggested that maybe we would see that. But no, the FTSE kind of in the mix with the CAC 40 and the Xetra DAX, both of those moving higher this morning. The IBEX over in in Spain up by 0.4%. Thinking about where the US futures picture is, though, Tom, and thinking about the still big unknown in the trading day ahead, which is the US CPI picture, raises questions about whether these gains in European stocks are maintained. But for the moment, we move higher.
And again, I'll repeat, the European stocks have outperformed their US counterparts so far this month. We'll see if that continues. Across your sectors, travel and leisure at the top of the list, gains of 0.6%. Also coming through with some relatively decent upside is tech as a sector that is seeing some upside as well, up 0.4%. Auto is also gaining 0.4. On the downside, just two sectors so far in terms of what we're seeing on selling. Telecoms down about 0.1%. Utilities also down just 0.1%. But broadly, this is very modest upside that we're getting across most sectors. Again, just two sectors in negative territory, and across the benchmark gains of around 0.2%. And we're also watching some individual names, of course, the likes of ST Micro and ASML in the tech space.
Yeah, absolutely. Yeah, it's interesting on a day where US futures are pointing quite decidedly to the downside now, down by 0.5% on Nasdaq futures. Europe is maybe increasingly going its own way, and we see most, as you say, most sectors in positive territory. Yes, there's catch-up from yesterday's US trade, but it's interesting nonetheless. Utilities and telecoms, as you say, the negative sectors this morning. Let's get some further analysis of what's happening on these markets then. 8:02, so 2 minutes into a European session that shows modest gains on this CPI day over in the US. Marina Zavalok joins us, Chief European Equity Strategist over at Morgan Stanley. Marina, nice to speak to you on this programme. Thanks for joining the opening trade. So I guess I want to ask you first off about the detachment between European stocks and the global narrative, because it seems on quite a few occasions we come in and we can join dots between what we're seeing in Asia and the US, but it seems to sort of bypass Europe. And some days that's great for Europe and some days that's not great for Europe, depending on where the rest of the global markets are moving. And often it has to do with tech. So how do you play Europe in that context?
Yeah, I mean, maybe I'll explain that dynamic first, which is that basically earlier this year, we had a lot of diversification flows coming into Europe. And since the Iran escalation began, back 3 months ago, that completely stopped. So all the flows basically started to go into the US week after week, flows into the US, basically nothing into Europe. So then when you have a market pullback, we're not participating as much in the pullback because we didn't participate as much in the rally to begin with. And then within Europe, I mean, you could take a tactical view. You can kind of look through the current volatility. We prefer to do the latter. We just refreshed our sector model. We would actually, on this volatility, we would be doubling down on the AI complex within Europe. So we've already liked the semis number one in our model, but
yes.
I mean, the fundamentals are just outstanding and they're just going higher.
Okay.
We also like mining. We would be buying it on this dip as well.
Okay.
Capital goods, we just upgraded.
So let me ask you about that, about Europe's AI complex then. Is that trade, is it linked to your view on the AI theme more broadly, or is it for the reasons that you've described, the fact that Asia and the US have moved in different directions sometimes to Europe? Is it kind of detached from your broader global AI view?
It's linked to the global view, but of course in Europe we don't have as much retail participation, so we've lagged the moves in the US and in Asia. So it's linked to the global view, but it's not as volatile in the current market volatility. And it has more catch-up to do as a trade. The AI trade overall is going to continue to broaden.
On the European AI theme right now than the US one, based on pricing and how far they've come?
I mean, me personally, I have a lot of conviction on the European AI trade, but I haven't compared them side by side because I focus on Europe.
How broad-based is that view on European AI? And are there parts of the stack that you want to be leaning into more than other parts? And you pointed out there's a smaller number, clearly a much smaller number of players. So is it a fairly broad-based view? Anything related to AI that sits within European tech, you want to lean into that, or is it do you bifurcate it a little bit?
I mean, there's definitely different pockets.
Yeah.
So there's the AI capex trade, where in the US you can argue that half of the market cap, at least, of the S&P is exposed to this AI capex trade. In Europe, it's about 15% of the European MSCI Europe or SXXP. That's our favorite part of the complex, and that's especially semis. And there's various cap goods, which are now the largest weights in the cap goods index. There's powering AI, that's utilities. Yep. That's taken a bit of a breather, but we still like it longer term. We think it's kind of a grind higher trade. And then there is AI ROI efficiency, which is less of a focus for the market, but we really like the banks for multiple reasons. One of them being that they're the first in line to see the ROI benefits.
The banks
are
the first in line to see the ROI benefits of AI.
Yes.
That's interesting. Is your call on miners, your positive call on European miners, is that also an AI story?
That's also, copper, our commodity strategist estimates about 1/3 of demand growth is AI linked. But copper has other drivers as well. There's supply constraints, supply disruptions. There's a lot of inventory building both in China and in the US. So it's a dynamic story, but it is AI related.
Can I ask Marina what kind of upside you would expect to see for European stocks if we see some dramatic developments in the Middle East, by which I mean a medium-term peace deal, even just a short-term extension of the ceasefire?
Yeah.
What kind of expectations should we have about the upside that still remains for European stocks on that kind of theme?
Yeah, so if we had, say, an MOU agreement announced one day here in the future, then we think this would unlock inflows that have been lacking in European equities and a broadening. And the upside we estimate just in the short term from that kind of tactical dynamic is 3 to 5% tactically. And then longer term, we have 10% upside to European equities, but probably upside risk to that.
Is there a limit to the bounce because of a perception that perhaps this war, this issue could return? You know, the Strait of Hormuz has been closed, and so it could be closed again.
Yeah, I think there's the initial trade on any deal, which is the market will just assume that it will remain, the deal will lead to a resumption in flows. Yeah. And we'll have that 3 to 5%, sharp spike higher. Probably half of it will happen day one. And then there's the trade after the trade, which is thinking about, well, how quickly will the Strait of Hormuz reopen? And how much of this has already been priced in, because we've had various waves of the market pricing in imminent deals.
We're looking ahead, of course, to the European Central Bank and its action tomorrow, and markets not quite consensus, but almost there in terms of expecting an ECB hike, and the market's pricing in more than 2 hikes this year. So I'm thinking about the European economy, I'm thinking about discretionary.
Yeah.
Is something like discretionary something you'd steer clear of? How are you thinking about the European consumer and sectors related to that?
We're underweight discretionary retail. It's a tough environment. I mean, a lot of the macro indicators that are Europe specific are deteriorating. Hiring is slowing down. It's one of the, in general, I'm not very worried about ECB hikes. In general, for the index, as long as it's moderate level of hikes, it's good because we have a lot of exposure to banks.
Yes.
But for these smaller pockets, like discretionary retail, real estate, I would steer clear, and we're underweight.
Discretionary retail, real estate, but banks get another boost, not just from AI and ROI, but also higher rate environment.
Yeah, definitely. Higher yields, steeper curves, very bullish for banks.
So you like the banking sector. What's your concern? What's the thing that could undermine the way you're thinking about European stocks right now? So we've talked about AI, we've talked about banks, talked about mining, and I guess one of the big challenges is what's going on in the Strait of Hormuz.
Yeah.
There's a huge amount of new listing coming to the market around AI. What worries you about your strategy at this point? What's the biggest unknown?
I mean, my biggest concern is that every year for the last 10 plus years in the summer, Europe trades choppy and sideways in aggregate as an index. Choppy, sideways, one day we're up, the next day we're down. Even under the surface, you will have momentum unwinding, the short momentum leg squeezing one day. So it's a bit of a directionless environment, period,
that's
seasonally.
World Cup.
Yes. Yeah.
Although
Anna's obsessed with this story.
I am obsessed with this, but I mean, it does often distract. I remember working in a bank, and the bank had to put on screenings because they anticipated that if they didn't, people would leave the building.
Yeah, we have all of our flags going up in my.
Yeah, you see, it can be
Anna's front running the fact that you're going to be.
It's a huge
distraction.
Yes, I am. I'm making excuses for myself, perhaps. Although I will say these things happen late in the European day, don't they?
So
this time around. So maybe it's not quite the distraction.
But back to your question, I'm less concerned about material downside. I'm more concerned about a lack of direction, choppy sideways markets, and that some of these fundamental drivers that I'm talking about, they are more material. I mean, Europe tends to take a life of its own at the end of the year and in 1Q. So just having to wait for that period where we can focus on European drivers.
Just picking up on the World Cup again, Marina, is there a case that you could see some consumer stocks jump on the back of the World Cup?
I think less so in Europe.
Less so in Europe.
Yeah.
Okay. Don't lean in necessarily to the drinks makers of the Netherlands and elsewhere. Marina Zavalok, thank you very much indeed. Really interesting views on the European equity space as we see that outperformance, at least this month, European stocks versus the US. Morgan Stanley's chief European equity strategist. Let's look at the core six for today then and check in on some of those movers. Standing out right now, Nestle actually talking the consumer up 1.2%. So a decent session so far, a decent print at least, early days for Nestle. On the downside, you're seeing a bit of pressure when it comes to that AI story, because Schneider Electric does have exposure to data centres, currently down 1%. ASML also a little weaker, despite the strength coming through from TSMC and their sales on AI demand. ASML is actually down 0.3%. Rheinmetall and defence space, that's been under pressure in recent days, currently down 0.3%, but a decent session for LVMH, up 0.9%. And Novo also getting a lift, up 2 points. Let's cross over to Alex. Alex Morgan standing by with some of the other names on the move this Wednesday. Alex.
Morning, Tom. Yep, WH Smiths, as we were talking about earlier, expected to get a hit this morning. They're down around 15%. Now, they've had, if you like, sort of a profit forecast cut. They've had that capital raise and an impairment charge, now 16%. So the stock very much in the red. WH Smiths, of course, having moved to focus on the travel sector being one of the areas hit by the conflict in the Middle East. All right, let's flip it over and have a look then at other stocks on the move this morning. Sanofi, now, you were talking about them. Of course, they've had a new hit for the CEO to deal with, down around just under 1%. That was focusing on the autoimmune drug that's just been pulled, so that's another headwind for Sanofi. Turning over then to have a look at something else, another one on the move this morning. Yeah, ST Micro, this is an interesting one, up around 2%, this course on the semiconductor trade. And just finally, we've got Adidas, which are on the move this morning. Adidas, you were talking about the World Cup there. I can tell you, as an Englishman, it's always a nervous time around the World Cup. But Adidas around 1% up this morning. They had an upgrade to buy from BFOA, and that's putting them alongside some other names like LVMH. So Adidas in the green, WH Smith this morning very much in the red, Tom.
I'll pick up, Alex. Thank you very much, Alex Morgan, with your movers and ahead of the World Cup, of course. Coming up on the programme then, we'll be back to the tech theme. Anthropic releases its latest AI models, but there's one big caveat. Find out what next. This is Brent.
Welcome back to the opening trade. We are 16 minutes into today's session. You're seeing some modest upside coming through for European stocks across the benchmark, up 0.3%. Of course, investors, many of whom will be holding their breath ahead of inflation data out of the US. The biggest gains coming through right now for the FTSE MIB over in Italy, up 0.6%. Here in the UK, the FTSE 100 adding 24 points at 10,251.
Let's talk about some corporate news flow here in the UK. The owner of Boots is reportedly in talks to sell the business for around $10 billion. That report coming from the Financial Times, which says that Sycamore Partners, which took control of Boots last year, is talking to parties including the billionaire Weston family and the Australian pharmacy group Sigma Healthcare. Let's get more then with Jennifer Creary, Bloomberg's global business reporter, who is with us to give us the latest on this story. So why could Sycamore Partners then want to offload Boots? Jen, bring us up to date.
Well, because it could be potentially very lucrative. So a potential sale of Boots could come in at about $10 billion. That would make it the largest for a UK retailer since 2021. That's when private equity firm CD&R bought supermarket chain Morrison's for $9.4 billion. So in a way, this is Sycamore's modus operandi, right? They want to cash in on Boots' recent turnaround through either an IPO or a sale. Boots itself is set to get a new CEO. It's got Alex Baldock coming in, formerly of Currys. So Sycamore would be going out on a high. I think what's really interesting here are the prospective buyers. So the FT is reporting that Sycamore is in talks with the billionaire Weston family. So they're the owners of Associated British Foods, as well as the Australian pharmacy group Sigma Healthcare. Now, the FT is also reporting that talks with strategic buyers started before Easter. So what does this tell us? If the Westons buys Boots, it'd mark the family's return to UK retail after it sold Selfridges for £4 billion in 2022. And if Sigma buys Boots, then it would signal an acceleration of the Australian group's international expansion. So Sigma recently formed a joint venture with a chain of pharmacies in and around London called Greenlight Healthcare. So this isn't the first time that the city has seen a potential proposed Boots sale. Walgreens first explored a sale of the chain in 2022, but the sale process was pulled after bids failed to meet expectations. So let's see if things change this time around.
So, Jen, we can rule out an IPO for now. Is that pretty clear? That sounds like bad news for London, at least for our capital markets.
Yeah, exactly. So if an IPO doesn't take place, it would come as a blow to the City of London. So bankers were hoping that several kind of household names, including Boots, Waterstones and Superdrug, could really buoy London's IPO drought. So it would certainly be a disappointment, but it's also worth noting that the FT report says that these talks are at an early stage and no decisions have been made over a sale yet.
OK, yeah, an important caveat. Bloomberg Global Business reporter Jennifer Curry, thank you for getting us up to speed on that story. Meanwhile, let's get back to the IPO story that we know is going to happen, which is SpaceX, the IPO on Friday. Concerns, of course, are being raised about the potential impact of demand then for the company's shares from index tracking funds. With us now is Bloomberg Equities reporter Henry Wren. Henry, what are the concerns when it comes to SpaceX, its IPO, and how these funds, ETFs and others, index funds, are exposed to that stock or will be exposed?
Yeah, so many of the index providers, they have announced that they are going to fast-track SpaceX into their indexes, right? So that includes the likes of NASDAQ and FTSE Russell. So when you think about it, according to third-party research, about 30% of SpaceX float will be bought by those passive funds in just 15 trading days, a very short of time. So we're talking about, in terms of volume, about $22 billion US here. So why is this important? Well, think about it, because those passive funds, because they're buying based on rules, so they will automatically generate upward pricing pressure in SpaceX. But also in the meantime, if you're an active investor in anticipation of passive buying, you would also buy as a result, because you're thinking of there could be upward pricing pressure, so we'll buy into it as well. So this upward pressure is self-reinforcing. And then we look at the other side of the market, the other stocks, because for index funds to buy into SpaceX, they would have to use the other stocks to fund their purchase. And for the sake of that, they have to sell the other stocks. So other stocks may face a downward pressure instead.
Yes, so the portfolio effects of all of these big listings, certainly an area of focus, Henry. And so the AI build-out is part of the SpaceX narrative, and it's certainly been something that has been supporting some of the AI universe within Europe, and ASML is one of those. You've been writing about ASML. I was looking at the year-to-date gains for ASML, up by more than 60%, but that's not actually that impressive, is it, given the company with which ASML sits?
So on the surface, indeed, like ASML, as you mentioned, up 60%, near a record high as well, one of the Europe's pride for sure. But if you compare to the other folks in the industry, like, for example, its peers like Applied Materials or Lam Research, or its key customers like Intel and Samsung, its gains are lagging. Actually, our data would show that on relative basis, ASML's valuation is close to a decade low versus its key semiconductor equipment peers like Applied Materials. So what's really going on here again? So there are some concerns in the market about its supply capacities. So obviously the demand is very strong. It's not a concern. But how fast can ASML ramp up its supply? This is question number one. And question number two being, like, how, in terms of its key customer, TSMC, how fast it could adopt its next generation of EUV machines, its most cutting-edge, advanced chip-making machine. So that's another question as well.
OK. Henry, thank you very much indeed with the deep dive on ASML. Well worth a read. And the potential market implications, of course, of SpaceX and its IPO. Bloomberg Equities reporter Henry Wren. Sticking with tech, the IBM CEO says AI will change the shape of workforces, but won't necessarily lead to fewer jobs. He was speaking exclusively to Bloomberg's Romain Bostick at the Mizuho Technology Conference in New York.
I'll give you an example. So you can certainly improve productivity of individuals. We'll call that productivity apps. That's where both economists and CFOs get very concerned. But where's my bottom line on that? Is it leading to less expense or more revenue? Where is that? And that's hard to find. But let me give you a second example, and you'll say, OK, I can see that. we are pretty acquisitive. Anybody who does M&A, you often bring the entity in, and actually normally your profits might decrease for the first year or two until you take all of the cost and get the cost synergy. Using AI tools now, we can probably add 10 points of profit synergy on day one, because the amount of time it used to take to move contracts over, to do all of the sales automation, to do all of the revenue forecasting, all of that now using AI can be shrunk down to literally a few weeks. If you can do that, I can now take that 10%, I'm not saying it's 90%, but 10%, and invest it instead in marketing and R&D and innovation to drive the revenue growth even higher. That's an example of what I mean by use the AI to really fundamentally change how you do business. It's got to become part of your operating model of the company.
Are you taking that medicine yourself internally?
We are. In the last acquisition we did, we actually managed to take out about 60% of the G&A on day one.
What's the message, though, that you have, not only for your partners, but also internally for your own workforce with regards to how this actually not only helps, but maybe the idea that maybe it requires a smaller headcount?
It's not necessarily going to be a smaller headcount. So a lot of people talk about this. So let me give you an example. On college hires, we tripled our hiring in 2026 compared to 2025.
Okay.
For
entry-level positions?
For entry-level positions, tripled. Absolute number, tripled. So you look at me and say, why? Because my belief is if these tools make people who are coming in out of college more productive, quicker, that means we are going to be advantaged by having more capacity to build things at a cheaper cost point, which means we can go get market share. Will the shape of the workforce change? Absolutely. But I think there will be more people in the value-driving functions, be it R&D, be it sales, be it marketing, and the creative activities. And some of what I would call classic back office will decrease because you don't need so much there. So the shape of the workforce changes. Total employment is not decreasing.
Okay, IBM CEO Arvind Krishna speaking to us exclusively with views there on how AI will reshape the labour market. For more on the tech outlook here in Europe, and particularly London's role in the AI boom, check out the latest episode of Bloomberg Tech Europe. It's at 8:30 a.m. UK time, airing this Friday.
They come around quickly. Excellent. Essential viewing on the tech story. Coming up on the programme then, Tom, we're going to get into the subject of private credit, and that links to technology, doesn't it? Because at the beginning of this year, we spent so much time talking about the links between software and private credit. That led on to lots of conversations about retail investors trying to get their money out, about gating, redemption requests. A feature, not a bug, is the message you were hearing earlier on from Apollo.
Yeah, Scott Kleiman of Apollo saying that there will, though, need to be, because of the lack of exits, at least in the industry as a whole, some capitulation, particularly as interest rates normalise. So we'll have a lot more on that. We're going to head back to Super Return in Berlin. We're going to be speaking, Danny Berger, to James Reynolds from Goldman Sachs Asset Management. Going to be asking him why he sees resilience in the private credit market. That is next. This is Bloomberg.
You're back with the opening trade, 30 minutes into our session that shows Europe standing out from the crowd, really, when it comes to the global narrative around stocks. So Asia under pressure, selling in the Asia session. The US, it seems, the futures picture there looking weak as well. NASDAQ futures now down by 0.6%. So a continued focus on technology weakness. Now, to some extent, Europe has not played in the technology boom as much as other parts of the world, as we were hearing from Morgan Stanley earlier on. So maybe that leaves us with the ability to go our own way a little bit. For today, it's the CAC 40 that outperforms, up by 0.4%. Other markets in Europe actually pretty flat, but the CAC 40 lifted by a combination of energy stocks, technology. So those are the themes that lift us a little bit higher, with the DAX broadly flat this morning. Tom, what do you see under the hood?
Yeah, it's also worth noting volumes are down about 20% versus that 20-day average. So that's also a factor. Maybe a bit of a story around investors on the sidelines ahead of that big macro event, which is the inflation, the CPI data out of the US. Across the breakdown, though, that you're seeing across the stock 600, you are seeing the majority of stocks in positive territory then. 400 stocks seeing some upside. On the downside, 185. So that is the breakdown broadly in terms of gainers and losers. If we look at some of the individual names on the upside, interesting to see as we think about the NASDAQ 100 called lower again. ST Micro getting an upgrade from Bank of America. So that French-listed company gaining 2%. Again, on the AI story. So some upside there for one of the tech names in Europe. And it was interesting to hear from Morgan Stanley saying they are bullish on European AI names. Adidas up 0.9%. This is also an upgrade coming through. And a view from RBC that actually the luxury sector could turn around. LVMH then getting a lift on the back of that as well, up 0.8%, adding close to 4 points. On the downside, let's flip the board. WH Smith, potential impairment. There's the impact of what's happening in the Middle East. So that stock is down and down hard, down 15% right now, the retailer. So global ramifications as a result of the Middle East and an impairment charge. That is a challenge. Sanofi is currently down 1%. It has halted an autoimmune drug trial, not getting the results it was hoping to get. So that is a negative for Sanofi. And Nokia, which was under pressure yesterday, it is exposed to the data center story, currently down 2.6%. And there is a view maybe that the TSMC numbers, with the read across to the sector here, maybe not quite as strong. Sales were up 30%, but maybe not quite as strong as some of the estimates out there. And Nokia potentially exposed to that story, currently down 2.6%. It has been a bit of a bellwether around the AI story. Anna.
It has. Let's get an update on some of the other stories we're following this morning. And we'll start with developments in the Middle East, Tom. US forces carried out strikes against Iran hours after President Trump blamed Tehran for shooting down an American military helicopter off the coast of Oman. In response, Iranian state media said the country hit 21 US targets across the region, including sites in Jordan and Bahrain. Supermicro shares fell in extended trading after it announced plans to raise $7 billion through a package of equity offerings. The proceeds will be used to purchase components needed to fulfill customer orders for its AI servers. Supermicro says it currently has around $39 billion in outstanding orders. And Taiwan is said to be considering tighter export controls on AI chip sales to China to further align with US measures. Sources say the proposal would restrict sales to all Chinese customers and allow authorities to prosecute chip smuggling as a criminal offence for the first time. The move is part of ongoing trade talks with the United States. Tom.
Now, the biggest names in private equity are back in Berlin for Super Return, the global industry's largest event. But with returns for investors dwindling in recent years, dealmakers are likely to face demands to hand their money back. Let's take you back then to Berlin and Bloomberg's Danny Berger, who is on the ground with another great guest. Danny.
Tom, thank you so much. That's right. I'm here in Berlin and so pleased to say that joining me now is James Reynolds, Goldman Sachs Asset Management Co-Head of Private Credit. James, thank you so much for joining.
Thank you for having me.
And there's a moment where it feels like your industry, at least the media attention, had kind of calmed down a little bit. But in recent weeks, more redemption requests, be it Cliffwater, be it from BCred, still this concern looms large. Does it just show to you that the kind of stress in the system, that it's here to stay for some time?
I don't think so. And first of all, we need to contextualize a little bit. You know, the media gets access to the BDC,
right?
Because only the BDCs do report.
Yeah, right? I should probably clarify the stress in the retail
raw materials, right? But that's only about 450 billion in a context. Direct lending is about 6 trillion, and I would also have the broadly syndicated loan market in that, because at the end the borrowers are the same. So that's 6 trillion. By the way, when we talk about private credit, and you start looking at private IG, investment grade, and also ABF, you're probably talking about a 30 to 40 trillion asset class. So we need to contextualize a little bit. Like the news flow is a narrow lens onto something that is much bigger, and it's difficult to extrapolate.
Well, perhaps the reason that it's been brought on this narrow lens is just the fact that this industry, not necessarily Goldman Sachs, but a lot of your peers, basically pinned their next leg of growth on retail, that this was the future, the democratization. And I just wonder if that narrative has also shifted, that this industry needs to take a step back. I mean, your co-head, Vivek, has been very clear, you know, the term, and you as well, that the term semi-liquid doesn't make sense. Gates are a feature, not a bug. Do you think that the lessons have been learned for this industry, or is there still some maturing that needs to be done?
Look, I think, and we've been very clear about these vehicles should not influence how a GP does invest, right? And, you know, there are a lot of benefits to these vehicles, but if you think about our platform, about 85% of our platform is made of different type of vehicles. You know, more sticky, long-term, patient, institutional type investors. And so it's very complementary to what we have as a platform, but it's not the sole driver of how we do invest, right? And that's really important for us, and that has allowed, to create, I would say, further growth on our platform, but the growth has not solely come from those vehicles.
Got it. So is that basically...
And the mix is very different for us, is what I would say. I was saying to you earlier, 20% would be institutional investors in these, in our private BDC, about 40% would be Goldman Sachs, wealth management clients. So the mix is a little bit different as well. And so you're starting to see dispersion.
So what difference does that make to you then if you do have some of these BDCs pulling back? Are you just seeing less people in processes, for example?
Yeah, so what happens, by the way, a lot of the attention is on the outflows. We really need to look at the outflows, the inflows, the repayment as well. So it's a more nuanced picture. But what it means is that there's less capital available to be deployed. If you think about the BDC industry as a whole, it went from 60 billion of AUM in 2021 to 450 billion roughly in 2025. So very active, and you could say that the marginal price setter was the BDC industry in the US. By the way, we're talking US here again. Sure. We need to contextualize. So right now, with that industry being somewhat on pause in terms of capital available to deploy, the yields have increased, right? Supply demands, the yields have increased 20% at least in the US compared to maybe 3-6 months ago. We have capital, we're deploying, we're very active. I was saying earlier that Q1 was our most active investing quarter. Our business is also very global and diverse, doesn't rely solely on our US BDC to be active, but yeah, this is a good environment for us to lean into.
When you think about activity levels for the industry as a whole, maybe they're more depressed, but I wonder for GSAM specifically, if you would compare this to a 2021, for example, which is how your volumes actually look, what would you compare this period in history to?
I would say first our business is much more diverse today than it was in 2021. We have new businesses that didn't exist for us in private investment grade, asset-backed finance. The main difference is that the capital structures today take into consideration the fact that the rates are higher, much higher than they were back in 2021. I would say M&A volume is lower. If you think about M&A volume in particular when it comes to private equity M&A, it's lower certainly than it was. But I would say because you probably have less availability of capital, certainly less from the BDC standpoint, again, the yields are more attractive overall than they were back in 2021. And so, we have the opportunity with kind of how the platform is set up to lean into a market where we think the opportunities are more attractive, or lean back, slow down, and that's what we've done, frankly, in 24, 25, in particular in the US. If you look at those kind of 2 years or year and a half, we invested more outside of the US, where we found better opportunities, better priced, maybe slightly more reasonable leverage levels. And now is a good time actually to lean back into the US.
So if a large part of that is because there are just less players who are present in the market, does that dynamic continue? Do you think it's an industry that shrinks even more than it already has and presents more opportunity for GSAM?
I don't think the industry is shrinking, by the way. I mean, again, you have to net the outflows with the inflows.
Sure.
Right?
But something's happening if it's just less competitive.
It's on pause. I would say it's on pause.
Okay.
I think it's a test for the industry. Performance matters, right? Underwriting matters. And you're starting to see dispersion in performance. I was saying earlier, we're starting to see a real flight to quality, in particular amongst institutional investors. They're looking at the performance and they're starting to vote with their feet as well. So I think the industry is on pause. I mean, we've been doing private credit for 30 years and 26 years for me. It's been a very good asset class, certainly for us, consistent returns, especially when you also adjust for the risk. So I would say it's not shrinking. We're still growing, by the way, certainly for us. I think the industry as a whole, maybe some parts of the industry, maybe it's more on pause, but if you think about private investment grade, asset-backed finance, I mean, this is also a growing part of this industry.
Well, one of the parts of the industry that it felt like it was on pause was tech-related deals are way down. Software valuations have come under pressure. How are your software companies performing right now? What does it look like on the ground?
Actually, our software sector across our portfolio is one of our best performing sector right now, and we just finished our portfolio reviews for the first quarter. We also learned to, you've got to be nuanced, right? Not all software is created equal, and we've had a framework for a long time, by the way, with dedicated teams, in the US and in Europe to software and healthcare, and our software investments tend to be very large, very entrenched, systems of record, mission critical, high risk of failure. And right now, the key question really for those companies and their owners is embrace AI. Embrace AI, embed AI in all your features, in your product suites. We're not seeing churn away to AI native. We're not seeing downsell because of AI. But the key is to embrace AI, and then hopefully we'll see, and we're starting to see it for the market leaders, acceleration of the top line, and then we'll see whether it also provides a margin boost in the next few quarters.
Can I just say, just hearing you being one of the leaders of private credit saying that software is one of your best performing businesses, it's just so counter to what we've been hearing at the moment. So does that mean that this is even a sector that could grow within GSAM, that it is successful clearly on your platform and you're not backing off of it?
Well, we're constructive about it. We also need to answer the questions from our LPs, and so we're being very detailed about this is the type of software that we like and that we would underwrite, and this is what we have shied away from, right? Also, these businesses that we have in our portfolio tend to have very high margins, they're very cash flow generative. I mean, they're really they're special businesses. And so, but there's a lot of education to be had as well with our own investors, right? Because they read the same headlines. The public markets, by the way, starting also to differentiate. When you look at valuations of software businesses, 3 months ago, the whole sector took a plunge. I think right now you're starting to see a real differentiation amongst the software companies.
On the point of margins, I wonder how much you're looking at the cost of compute. It feels like this narrative that is starting to creep in of these companies that are having to adopt a lot of AI. You hear stories of Uber runs through their entire year's tokens budget in just a couple months. Are you starting to see that filter through some of your portfolio companies, just how expensive it is to run some of these systems?
Not yet, I would say, but that is certainly a consideration for management teams and the owners. By the way, that's going to create a further barrier to compete and further barrier to entry, because scale does matter. When you think about the investments that you need to make here, the cost of compute, the tokens, I think that's going to favor the more scaled businesses. That's true to software, that's true everywhere, it's true in our industry as well.
So it just goes back, benefits Goldman companies yet again in this trend.
Yes, it will benefit the larger scale players, and I think that's true across most industries.
All right, James, unfortunately we're out of time. Thank you so much for joining.
You.
Really wonderful to
see you.
Great to see you as well. Tom, Anna, that, of course, is James Reynolds of Goldman Sachs Asset Management.
Danny, thanks very much. I'll pick up Bloomberg's Danny Berger live on the ground at Super Return, and her coverage continues throughout the day. We'll be hearing from guests including Victor Kozler from Strategic Value Partners and Thoma Bravo co-founder Orlando Bravo. Coming up on the programme, oil is ticking a little higher this morning, up 0.3% as traders weigh fresh strikes between the US and Iran overnight. The ceasefire clings on. We have the latest from the region next. This is Bloomberg.
Welcome back to the opening trade. We are 47 minutes into today's session. You're seeing European stocks modestly higher by 0.2%. Strongest gains coming through for the Italian FTSE MIB, up 0.9%. Here in the UK, FTSE 100 is gaining 18 points, Anna.
OK, let's focus in on oil because it's ticked a little higher, actually, this morning, just up 0.1%, though, 91.63. But it's been quite a journey over the past 24 hours. We've seen the United States and Iran exchange strikes once again overnight. President Trump said the US retaliated against Tehran for shooting down an American Apache helicopter. For more, we're joined by Bloomberg's Abir Abu Omar, who's in Dubai and can bring us up to speed. I mean, we still talk about the ceasefire clinging on, Abir, even though we've seen the US and Iran exchanging fire by some definition, at least overnight. Bring us up to speed.
Good morning, Anna. So look, I mean, the question we woke up to this morning was what ceasefire really when you see these hostilities taking place over the past week and into this morning. So what happened overnight was that the United States troops had attacked Iran. Some parts in central Iran were attacked, according to IRIB, that is the state-owned media in Iran. And this is essentially what the U.S. had said. This is what CentralCom had said about the attack, saying that it was a proportionate attack attack in response to Iran downing a helicopter, a U.S. helicopter, yesterday. Now, President Trump did tell ABC News yesterday that he has to respond in a powerful way to the downing of the helicopter. This morning, Iran retaliated against the attack by attacking GCC countries. That includes the Fifth Fleet, the U.S. Fifth Fleet in Bahrain, and also a U.S. airbase in Kuwait, but also in Jordan as well. So you're seeing an uptick in these hostilities between the United States and Iran following what we saw at the beginning of this week, where Israel got directly involved in Iran again by attacking central cities in the Islamic Republic, including places in Tehran, the capital. Iran retaliating by hitting northern Israel as well. Meanwhile, look, the incursion of Israel in Lebanon continues. It is the deepest in 25 years. That is a sticking point for Iran, where it said it will not come back to the negotiating table unless Israel's attacks against Lebanon cease to happen. But President Trump maintains that the truce talks are still ongoing, that they are continuing to be intense, and that is definitely something that we're keeping an eye on over the next couple of days.
Abir, what does this mean for the oil markets? There's some reporting that Kuwait is actually getting oil onto the markets for its Asian buyers.
Yeah, so look, Kuwait is providing about 4 million barrels of export crude or export materials crude to countries in Asia, including South Korea and China. This is more evidence to show that a trickle of shipment is coming back to the Strait of Hormuz. Now, inevitably, it's not what it used to be pre the war in late February, but we've seen signs over the past couple of weeks about movement coming back to the Strait of Hormuz. But again, look, as I mentioned, it's nothing compared to the movement, the normal movement of the tankers and ships in the waterway that used to carry 20% or so of the world's crude shipments. But something, again, to keep an eye on, it is a sticking point for President Trump to reopen the Strait of Hormuz if this MOU that we've been talking about over the past 2 months or so is reached, along with an extension of the ceasefire for 60 days, and then the other concessions will be discussed at a later stage, Tom.
OK, Bloomberg's Abir Abu Omar in Dubai with that update. Abir, thank you. Let's look at what else we are monitoring throughout the day. The Bloomberg Invest event continues, or at least begins, in Hong Kong. The annual super return is underway. Danny Berger's on the ground for us in Berlin with some fantastic conversations and insights. At 9 a.m. UK time, we're going to get Italian industrial production. At 1:30 p.m. UK time, it's the big one. Key data, of course, out of the US. May consumer price index data, CPI data, and aftermarket stateside. On the earnings front, Oracle's fourth quarter results.
Let's turn to Skylar Montgomery-Koenig from the Markets Live team for some analysis ahead of the key CPI print, which is coming out of the US later on. Good morning, Skylar. So what's your thinking going into this number? Clearly, we're impacted by Friday. The jobs report was really strong and had a big impact on markets. As a result of that, do you think we're primed to see more of the same, sort of doubling down on pricing in a Fed hike in December? Or is the risk that actually we see something dovish?
Yeah, I mean, I think it's a very, very high bar to get a dovish print. And I'll give you 3 reasons for that. The first is just the momentum and data has all been one direction, right? Economic surprises are positive. We've had 3 above expectations non-farm payroll prints that have been very strong in a row, and inflation surprises are already positive as well. The second is, if you look at economists' estimates, there's this bias to really believe in the Fed's inflation fighting ability. So if you look at economic surprises prior to 2022, 2020, through the 2010s, they were biased very much to the downside as the Fed kept missing its inflation target. In the 2020s, they've been biased upwards. So you've had inflation surprises very much tending to be to the upside. And then finally, I'll just say there's no world or no one expects a low inflation print or an inflation print that's in line with the Fed's target. So if you look at consensus estimates for headline CPI, that range is 4% to 4.3%. So if your low range or your low estimate is 4%, that's still very concerning and tells you that the direction of inflation is upwards and hawkish.
Skylar, what happens to the 60-40 portfolio in this environment? You're seeing a correlation between bonds and equities.
Yeah, absolutely. So if you look at the 3-month correlation between bond and equities, since the Iran conflict started, that's been positive. And it's really worrying for investors because the idea is when you have inflation come in from a supply shock, that inflation being higher means that the Fed has to react hawkishly. That's negative for bonds, but it's also negative for growth, which isn't as positive for equities either. So they sell off together. So going into this inflation print, yes, we very well could get a downside surprise, and that would boost bonds and equities together, whereas an upside surprise would have them sell off together. But I think the worry from a portfolio perspective is that your bonds aren't insulating you anymore. If they're not moving in opposite directions, then where is your protection coming from?
Yes, a topic of conversation on this program. Let's talk about FX and what is likely to happen with the dollar. So the dollar will be in focus as we get that data. We'll see what response we get there. But I wonder how much the AI dynamics are also sticking to the dollar as well. I mean, clearly the geopolitics also has been a driver of a recovery in the dollar over recent months. But the AI theme stands out to me. We're going to get the listing, of course, of SpaceX this week. We've got Oracle earnings coming later on today. So we've got news flow coming around AI, and I know Standard Chartered have been making this link between the dollar strength they see coming actually from the AI theme and the way that drives the US economy.
Yeah, absolutely. I think when I'm thinking about growth and inflation dynamics right now, AI is positive for growth in the US and it's positive for inflation, whereas the energy shock isn't as negative for growth in the US as it is elsewhere, but it's still positive for inflation. And the worry is when you have a supply shock, yes, it's technically a one-time supply adjustment. How long it lasts depends on how long energy prices stay high, but it can be persistent more so if growth is stronger, because that means that companies can pass on that cost to consumers. So the worry now is because AI is boosting the US economy, that inflation becomes more persistent. That feeds into your growth outlook for the dollar, so you get performance as well because people are wanting to buy US equities and US bonds with higher yields. But you also get yields moving in the dollar's favor recently. And so I think certainly the next few months, the outlook is very positive.
The relative outperformance of European stocks in the last 10 days, at least, does that unwind pretty quickly, given the dynamics you're pointing to in terms of AI in the US? Or is there space now for European stocks to start to put in a better showing?
I'm very hesitant on European equities. I think the growth outlook is quite negative because they're so dependent on imported energy. And the market's been focusing on inflation, rightly so, because inflation surges before you start to see that demand destruction. But we've had it long enough that you will get demand destruction. And I think people are saying, well, what if the bubble bursts? But if you look at the .com, when the bubble burst, European equities underperformed U.S. equities. So, if you're imagining a worst-case scenario, risk sentiment turns against European equities.
Thank you very much indeed. Scarlett Montgomery-Koenig from our Markets Live team. That is it for the opening trade. Currently, European stocks are up 0.2%. U.S. futures pointing lower. The Pulse is up next. This is Bloomberg.